President David J. Trump, you were looking to see me?
Yes. Come on in. I don't have all day.
All right. What are we talking about?
Well, here's the thing. I need you to keep interest rates low, and I need you to do it right away.
I'm not quite sure we can do it just like that, Mr. President.
Look, I'm the president, and I'm going to tell you where rates go, and I need them going down.
I hear you, but I'm chairman of the Fed. And I have some obligations that I need to make sure I'm protecting the economy here.
I'm not sure you're hearing me correctly. I need to make it even clearer if that's what it takes. Dirty Jerome. I need rates down, lowered, and I need it immediately.
I'm going to run the economy as I best see fit, President. I'm not sure you have the power to make that decision.
I've heard enough. You're fired. You're fired.
I'm not quite sure you can do that either.
You're fired.
We're going to agree to disagree on this one.
If you didn't hear me before, you're fired. Welcome, everyone, to another episode of Mortgage Monday. I am David J. Trump, joined today with my partner, Christian Batchelder, playing the role of Jerome Powell in our funny little skit for you there. And Christian, how are you doing today?
Doing good. Got some fun stuff to discuss today.
You play a great Powell. Let me just tell you that. That was perfect. All right. Normal question. How many files do you have in submission?
Still going strong. Around 60 myself, about 220, 230 as a brokerage. So still good volume, good production happening with the whole company as a whole.
There you go, folks. If you want us to look at your loan intake at theonebrokerage.com, you can also check out theonebrokerage.com to learn more about our products. Getting into this thing here, Trump has made his will known that he wants rates to go down. And he's either said or insinuated that if Jerome Powell, who's the current head of the Fed, doesn't do what he wants, that he will fire him. And Powell doesn't seem so happy about that. This post from BBC.com says, the head of the U.S. Central Bank has hit back at speculation that his post might be in jeopardy as Donald Trump prepares to assume power in Washington. Federal Reserve Chairman Jerome Powell said he would not step down if Trump asked, and that it is not permitted under law for the White House to force him out. Mr. Powell was responding to questions from reporters at a press conference after the bank announced a cut to borrowing costs, lowering the Fed's key lending rate to the range of 4.5 to 4.75. Forecasters have been expecting borrowing costs to fall further in the months ahead, but warned that Trump's tax plans for tax cuts, immigration, and tariffs could keep pressure on inflation and drive up government borrowing, which would complicate those bets. Trump has pledged to impose import duties of at least 10% on all goods coming into the country, costs that economists say would be passed on to consumers, helping to drive up prices. Now, in a minute here, Christian, I'm going to have you explain why Jerome Powell cutting the federal funds lending rate doesn't always translate into lower mortgage rates. And before I do, I'm going to give you guys all a quick brief lesson on macroeconomics. So when we talk about the Fed, which Jerome Powell is in charge of, it is an agency that I suppose is technically part of the government, at least mandated by the government, that has two main jobs or mandates. They want to keep inflation low and they want to keep unemployment low. So what they're looking to do is to keep people working, and they don't want inflation to get out of hand. The main way they control this is by moving interest rates up and down. Again, this is super high level. But in general, if you lower interest rates, more people spend money. If more people spend money, it creates more income coming into companies. As you have more income coming in, you have to hire people to service that income, unless you're using AI. But for the time being, that's still a job of a person. So lowered rates usually reduce unemployment and keep the economy healthy, but then lowered rates can also lead to higher prices or more inflation. So they raise the rate when they think that inflation's getting out of hand, but then that causes unemployment. So then they lower it again, and they kind of seesaw paying attention to these numbers. Well, we're here to talk about mortgages. That's why you're listening, and how to build wealth through real estate. So Christian, how come when the Fed lowers interest rates at the federal level, it doesn't always turn into a lower mortgage rate?
Yeah, two main reasons is, number one, it's not the only thing impacting rates. Number two is that banks are smart and they usually get ahead of it. So if the rate is projected to come down, we've mentioned this a lot on the show, but rates move with news, not action. So if the lenders think rates are going to come down, they get ahead of it, 3 or 4 months prior. Right. So we did see some rate drops from these last two rate cuts. We're recording this right after the one that just happened in November, where they cut 0.25%. And the one prior to that, they cut a half. Right. So we're down 0.75 bips over the last 2 months here. A little more than 2 months, but around that. And if you look back 6 months, we're down about that amount in mortgage rates, right? It just doesn't happen on the day of, right? So number one, banks are smart, they get ahead of it. But number two, it's not so much where the rate is right now, because just like 6 months ago, they predicted this. They care more about, and they being the banks care more about what Jerome Powell and the Fed are going to do 6 months from now.
Mm-hmm.
So let me give you an example.
Mm-hmm.
Let's say this isn't what happened, but let's say Jerome Powell came out and said, we're cutting rates by 0.25%, but we anticipate our policy is going to need tightening in the next 6 months. That means they're going to have to restrict fiscal policy, which typically means increasing interest rates. That would lead to increasing mortgage rates, even though today he cut the rate, because they're projecting out what is likely to occur going forward. So if rates on mortgages are moving down, two things are happening. Number one, that means employment is fairly strong. So that means there's not a whole lot of unemployment in America. That's fairly good, right? We want that. That means we don't have to cut or raise interest rates to combat that. But number two, the Fed has gone out into the future and they've projected fiscal loosening, which means, hey, we're going to loosen interest rates. We're going to drop rates. We're going to stimulate a little bit. We don't see a need combining inflation and unemployment to tighten fiscal policy right now. And that'll be a good thing. That means rates are going to come down as time progresses if the environment stays the same. Now, just like any election year, elections mess up the environment. We don't know who's going to get elected. I mean, now we do, but moving into it, we didn't know. Things are unknown. Fiscal policy starting to be discussed from the presidential standpoint. And there's a lot of instability when things like that happen. And the most instability can be viewed as we are right now, where if Trump just comes in and says, I'm going to fire Jerome Powell, can he do that? There's not technically a law written saying he can or he can't, but the Fed was created to be outside of government influence. That was the goal of the Fed, is that to have unbiased, non-politicized fiscal monitoring. And we're kind of towing those lines right now, right? And we'll see. Maybe they make a new rule that the president controls the Fed chair. Maybe they say, hey, he's good, he can act independently. But that is to be determined for sure.
So a few sticking points here. First off, Trump has said that he wants to increase stimulus of the economy. He wants to bring in more jobs. He wants to lower taxes. And theoretically, what this does is it makes money change hands more often, because if you, Christian, have more money to spend and you spend more, you create a job for somebody else. Whatever you go buy, somebody has to go make, right? Well, what that's going to do is reduce unemployment by increasing how many people are then hired, which will probably lead to inflation. And the Jerome Powell is going to want to stop inflation by saying, okay, I'm going to raise rates. But Trump wants those rates lower to keep the economy going good. So in a sense, Trump kind of wants to have his cake and eat it too. He's like, hey, I want to reduce unemployment. I want to create jobs. And I want us to keep these interest rates low so that we can get the economy chugging along again and get things productive. And Jerome Powell's over there like, well, my job is to balance these two things. So he's continuing to try to bring balance to what Trump is trying to create is inertia. Now, another sticking point, I thought that this was clever. Powell was named chairman of the Fed by Trump in 2017.
He sure was.
And then later became the frequent target of his criticism. During his first term, Trump called bank officials boneheads on social media and reportedly consulted advisors about whether he could fire Mr. Powell. This year, U.S. media have reported that Trump allies have been looking at ways for the White House to assert more control over the Fed, including potentially sidelining Mr. Powell by prematurely naming his replacement. Trump has said repeatedly that he believes he has the right to voice his views on Fed actions. He told Bloomberg over the summer that he would let Powell serve out his term, which ends in 2026, especially if I thought he was doing the right thing. However, Powell said on Thursday that he would not step down if ordered to by Trump, and that an attempt to oust him before his term is over is not permitted by law. Christian, how did things go so bad in paradise between Mr. Powell and Monsieur Trump?
Literally one word: inflation, right? Inflation chafes everything, right? It gets you all itchy, gets you all upset, makes everybody sweat. And we experienced pretty darn close to record highs of inflation the last few years. Part of that was stemming from the COVID stimulus and the rebounding of the economy. Part of that was, we've gotten into, ever since 2008, America's got into a real bad habit of we can print our way out of anything. We print, and with printing, basic rules of supply and demand, the more of something there is, the less it costs, right? And we usually think of that in goods, right? Like if there's 40 million diamonds everywhere, but there's not 40 million people who want a diamond. They're not worth very much. But that same thing can happen to a currency, right? If there's dollars everywhere that are just be printed and given out, and that started in 2008 with quantitative easing, which it's a difficult concept to understand. But the idea of it is that the government just bought away its own debt, right? So somebody else didn't have to pay that. And that's not, while it did rebound us from 2008 in the way it was intended, you give the kid some lollipops and they'll be happy for, an hour, but is that really the best thing for the kid long term, right? Now all of a sudden the kid's eating candy for every dinner, right? And that's what America really, if you just want to sum it down, what we've done the last, decade and a half, we've eaten candy for every dinner, and we pay the price of it. And people like Jerome Powell,
we're wired.
Yeah. People like Jerome Powell standing true and keeping rates high. Trust me, he was a very unpopular man these last 3 years, right? Cranking interest rates as high as he did. But it was a necessary evil. That was the kid diet, right? He was getting us off of candy and putting us back on, low carbs, high protein diets that we should have been on the whole time. Right. So it's
now
tricky.
Trump feels like we're sluggish and we need to get things moving again because nobody wants to work. So it's constantly a back
Only
and forth.
Rosie O'Donnell.
Very nice.
But
we got another article here from NBC Washington that says, as a candidate, Donald Trump promised to relieve consumers of high interest rates. As president, doing so will likely be a slow process that's largely outside of his control. So Trump sort of painted himself into a corner here because he was running for president. He said, I'm going to bring rates down. And then Powell kind of stepped in and said, yeah, well, good luck with that because you're talking about my realm. And now Trump is figuring out, how do I influence Powell to bring these rates down because I think that's what's best for the country. Yeah. And Powell's saying, well, I'm going to do what I think is best for the country. And so we've got a bit of a pissing match. Trump repeatedly said during the campaign that he would bring down rates without elaborating on how. He has suggested the president should have a say in determining rates set by the Fed Reserve and publicly berated the central bank and its chairman, Jerome Powell, for not lowering the rates sooner. But while Trump has put a lot of emphasis on the Fed Reserve as a way to reduce the interest paid by consumers or businesses, the rates on mortgages and other longer-term loans are outside of any one person or institution's control. Instead, those rates are largely determined by the bond market, where investors are looking for a range of long-term risks, like the likelihood of high inflation returning, prospects for economic growth, and the United States' ability to pay back its debts in the decades to come. Now, in my book, Pillars of Wealth, available on Amazon, any bookstore you ever go to, check that one out. I talk about how the Fed rate impacts mortgage rates, but it doesn't basically decide them. Christian, can you give us a little bit of an understanding of how mortgage rates are determined and its relation to the bond market?
Yeah, if you look at it in a bubble, interest rates are determined on investors' likelihood to buy mortgages, right? Mortgages, like many things, stocks, bonds, T-bills, everything, they're sold as what's known as a security, which basically just means an investment, right?
Yeah.
It's a fixed investment with a guaranteed return. Right now, mortgages have some risk to them. A lot of investors learned that in 2008. There is a risk of default. There is a risk that the borrower lied on their application. There is a risk the bank made a mistake and issued a bad loan. Those likelihoods are much, much more minimalized now after all the laws and regulations that went into place after 2008. But when an investor looks at a mortgage, they're basically purchasing your debt, which is called your note, for X amount of money. And they're receiving the 3 to 8% interest rate that you're paying over the course of your loan. Now, if that looks very good in comparison with other things like stocks, well, if stocks are booming and crypto's doing good and all these alternative investment tactics are looking good, there's going to be less and less investors to buy mortgage-backed securities. Now, that creates a difficulty where if there's not an end user or an end buyer for mortgages, how do we issue new ones? Right? That's one of the big things that banks and the Fed have run into.
Right.
And that, backing into what we said earlier, that was the start of quantitative easing. After 2008, no investor wanted to buy mortgage-backed securities because they were underwritten wrong and they were mistaken and they were bad loans. So the government stepped in and just bought all the debt. The government said, okay, fine, we'll buy it. We'll guarantee the U.S. mortgage market. They probably shouldn't have done that, right? We probably should have gotten back to a healthy diet on our own. And we've done a lot of that since then. Quantitative easing is something that has been practiced over and over since 2008. When stuff gets bad, the government comes in and buys its own debt, right? It buys the debts of the citizens in the way that we orchestrate mortgages. Now, diving one step deeper, on top of just who the end user is, there's also institutions that buy them. So not every mortgage, you've probably heard us talk a lot about, DSCR loans and hard money loans and portfolio loans. The U.S. mortgage market is much more fluid than it ever has been, right? Historically, it's always been like Fannie Freddie loans. That's like the vast majority of stuff on the market. FHA loans, VA loans, like the prime good stuff. That's what gets sold on the the secondary and tertiary markets in America. But there's kind of been this upswing now of non-conventional debt. That's DSCR loans, that's hard money loans. And those have an entirely different investor network. Those are not that, the government is never going to buy a bunch of DSCR notes. That's held by banks, held by capital funds, held by, institutional money. And that's starting to have a little bit more of an impact. And, some of the clients that I've spoken to, you guys will know if you listen to this, right now in today's market, you could potentially get a DSCR loan for a lower interest rate than a conventional investment loan. That's never been true. It's always been a less prime loan, a higher interest rate, a larger risk to the investor. And now the government rates have gotten so high that private investors just looking to lend their money are willing to accept a 7 to 8% rate on their return backed by real estate. That's like a fair return on investment, right? Mm-hmm. So something's got to give. I do think rates are going to be coming down. I don't think they're going to come down as fast as Trump may demand for them to. But I mean, for the last year, the Fed's trajectory has been systematically lowering interest rates now that inflation has curved back down to their target number.
Now, when Christian and I started the One Brokerage, we had to decide if we wanted to be a broker or a direct lender. And that doesn't really matter to you guys as much, but the basic choices were we could work for one bank and we could lend out their money and have a streamlined process that would frankly be easier for us. Or we could work with many banks and get better rates and better loan options, but we would be responsible for putting together a lot of our own underwriting, and the process would sort of be pieced together by he and I. It was better for the consumer to have a brokerage, so we took the uphill path of putting things together in a way that was tougher for us to be better for you. But one of the benefits is what Christian just mentioned. Rates go up and down differently on different loan types. HELOCs don't go up the same way that DSCR loans do, the same way that conventional loans do. HELOCs are going to be tied to the federal funds rate much more. What that means is there's sometimes, like Christian just said, where a DSCR loan could be cheaper than what a conventional loan be, or I suppose a jumbo loan could be cheaper than a conventional loan, and other times where it's vice versa. If you're working with a broker like us that has access to all these different lenders, we can get you with the cheapest lender that there is for your situation, rather than only having one product that we can offer like a lot of other lenders do and being stuck where your rate is whatever your rate is. So Christian, if people want to get a hold of you, where's the best place that they can go to start to talk about some loans?
Yeah, absolutely. On Instagram at The One Broker is the best place to catch me directly. Just shoot me a DM and I'll respond right away. Otherwise, if you're looking, maybe social media is not your thing, you can also shoot me an email at christian@theonebrokerage.com. Best way to catch me.
All right. This article finishes up by saying that the idea that the president can directly influence the Fed rate is a little unrealistic, but the broader policies or expectations of policies have a much more direct effect. So Trump is correct in understanding that he can influence or put some pressure on some of the decisions that the Fed makes, even if he can't directly fire Powell or force him to do exactly what he wants. And good politicians learn how to use their influence and their weight to move things in the direction that they think is going to be best for the country. We're going to end the episode by talking a little bit here about what rates are doing and where they could go based on some of the information that's been shared. This comes from CBS News, and it says a drop in the inflation rate, however, even if it's a minor increment, could encourage the Fed to continue its rate cut campaign. After all, if inflation dropped in September after a Fed rate cut was issued, and again in October ahead of the November's cut, it could indicate that the economy has recovered and is in a strong enough position to endure additional rate cuts to come. And additional rate cuts will undoubtedly lead to lower mortgage rates, even if the connection between both isn't always direct. We just explained to you all why it's not direct, but they're sort of related. Understanding this dynamic, then, borrowers looking to buy a home and the homeowners looking to refinance their existing one should prepare to act promptly. And the emphasis in that sentence should be on promptly. Remember that after a mortgage interest rate plunge in September, they rose by more than a point in October without a Fed meeting on the counter. So the Fed did nothing different, but rates went down and then they shot right back up. While that was due to a combination of factors, it emphasized the importance of locking in a low rate when available. versus waiting for a lower ideal rate in the future. If another opportunity presents itself this week, for many, it may be worth taking. Christian, I wanted to end today's show by just asking you to share what it was like for you a couple weeks ago when rates went down and you and I were basically up to our eyeballs in potential refinances. And it was maybe like a week or two that it lasted, and then boom, we went right back to a position where rates were up, and those that were looking to refinance out of their 7.5%, 8% interest rates were kind of in a position that they couldn't. Can you share what that experience was like?
It's very interesting. It's people want to jump when there's an opportunity. I get it. It makes it harder for purchases rather than refinances, because purchases, you have to get pre-approved and then go find a house. And in that 15, 30, 60 days that it takes you to find a house, the rates have gone up. Right. But refinances can lock in right away. So if you guys, we send out little info blasts, follow myself, follow David on social media. And we did that one, 3-4 weeks ago. We let everybody know, hey, if you have a rate over X, give us a call. We can refinance you. We can benefit you. Absolutely. Some people waited 2 or 3 weeks to reach out, and by that time it was gone. Right. Now, that doesn't mean it'll never come back. It just means, even though the Fed's trajected likelihood, and every pundit, every expert, every influencer out there has been saying rates are going to drop, they didn't the last month and a half. So what does that mean? That means we can all be wrong. Like, we're not perfect. We're human. We can only, interpret and predict based on the data that's on hand. And, a lot of people didn't predict how the inflection would impact rates, how the jobs report right before a potential reelection came back, and all of a sudden we created all these new jobs, and then it got revised down that there weren't a whole lot of jobs, so you can't predict things like that. You have to make sure that you stay up to date. If you are wanting to drop your rate on a refinance, you got to stay right on the ball, right? You got to be in talks with your loan officer. You got to get on a rate, a rate drip campaign. You got to get in touch with me or David. You got to give us a call the moment you hear something might be happening in the economy. Just because the Fed drops the rate, though, doesn't mean the interest rates are going to drop, right? Things need to happen that look good into the future in order for that to take place.
All right. Thank you very much for that, Christian. Again, if people want to reach out to you to talk about their mortgage, where can they go?
Yep. At The One Broker on Instagram. Christian at The One Brokerage is my direct email. Those are absolutely the two best ways to get me.
Shoot my man a DM. You can find me at davidgreen24 on social media, or you can find me at davidgreen24.com. You can also subscribe to The David Green Show on YouTube, Apple, or Spotify, part of the Real Talk Real Estate Network. Thank you, everybody. Please make sure you subscribe to the show to get notified when new episodes come out. We will continue to give you updates on what's going on with this administration and where we think rates are headed to help you save money and build wealth in real estate. This is David Green for Christian Batchelder. Signing off. We will catch you next week on Mortgage Monday.